Hey, hello investors and future investors. Welcome back to the channel. My name is Tim, and on this channel, I show you how I use my portfolio in order to make weekly income. For today's video, I'm going to show you how to consistently keep choosing the right strike price, or do I dare say the perfect strike price. Now, this is going to be part two to our previous part of how you can choose the perfect strike price. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. And now we have switched over to sell and put. Previously, we did sell and call. Now, similar to selling covered calls, whenever you do the cash secured put, there's only three different strike prices that can be chosen. Those strike prices are going to be at the money, in the money, or out of the money. So let's briefly go over them again because they're a bit different when you switch over to puts as opposed to covered calls. Now, all your at the money strike prices are going to be 98 and 99. The reason why these are called at the money is because they're the closest strike prices above and beyond the actual share price. So any price right below or right above the actual share price is going to be known as at the money strike prices. Now, the second set of strike prices that can be chosen is what's known as in the money strike prices. Now, all your prices above the $99 strike price and above the share price are going to be your in the money strike prices. And thirdly, your out of the money strike prices are going to be all those prices below the $98 strike price, below the current share price. All these here are going to be out of the money strike prices. Now, when choosing your perfect strike price when doing the cash secured put, it is highly advisable that you choose a strike price below the current share price, or in option terms, a strike price is going to be out of the money. Now, if you are confused with out of the money and in the money and at the money, that's quite fine. You could dissolve all of that and just say below the strike price or above the strike price. Always do what works for you. So now I'm going to go down and I'm going to choose my strike price based on my chance of profitability. Now, in part one, I did show you how to use the chance of profitability, or you could use the delta. So I'm going to stick with the chance of profitability. So now I'm going to go ahead and I'm going to choose my strike date. So you see right up here, it says the expiration is 1 day, which doesn't make much sense. So I'm going to go out to December 6th, which is going to give me about a week of days left in order for me to have this trade expire. So now I'm going to go ahead and choose my strike price below the current share price. Once again, I'm going to choose my strike price out of the money. So I will be going with the $94 strike price. And with the $94 strike price, I have a chance of profitability of 80%. And I also will be receiving a premium of 0.74 or $74. Please remember, each option contract is multiplied by 100 shares. Now, in order for me to see the delta, like I showed you in the first part of this video, you could go ahead and change your icons down here. The other way to do it is simply by tapping into the strike price, and that's going to open up the Greeks. So we're going to scroll down and we're going to find our delta. Now, our delta here is 0.21. So a word of advice, when I'm choosing my delta, I always like my delta to be 0.3 or below. That just gives me the best shot at becoming profitable on these trades. So let's go ahead and we're going to get out of there. Now, this is my perfect strike price. In order for you to choose your perfect strike price, always remember to choose what works for you based on a couple of factors. Remember, one of the factors is going to be your strike date. One of the other factors is going to be your investment goals, meaning how much premium you want to collect. So let's say you're a more conservative trader, you're trading with a huge account, let's say $100,000, and your main goal is to conserve your capital. So you want to do low risk trades. Well, that's quite simple. All you need to do, you need to go down a bit further in the money, and you could choose any of these strike prices here. Now, the relationship between the strike prices and the premium, and also the chance of profitability, is that the further down you go out of the money, it's going to be the less amount of money you have to pay per share, which also is going to mean the less amount of money you have to leave in order for your cash secured put to work out. Remember, for your cash secured put, it's going to be your strike price multiplied by 100 shares. So in this case, it's going to be $9,100. Also, the further down you go out of the money, that increases your chance of profitability. my perfect strike price gave me a chance of profitability of 80%. As I go down lower to the 91 strike price, my chance of profitability is now risen by almost 90%. The relationship with the premium is that the more you go out the money, the lower your premium is going to be. Initially, my perfect strike price, my premium was $74. Now, by going lower out of the money, the premium has reduced to 0.30. So why would I go with the $74 strike price instead of the $30 strike price? That depends on you doing your own DD. So let me show you very quickly. So I'm going to go into MU and I'm going to do a very quick DD based on historical data. So we're going to go to the advanced feature. We're going to go out just 1 year and we're going to try to get an average of support and resistance. So if I scroll right here, you can see this line goes straight across and it shows me support and resistance across the board after only 1 year of data. So this support and resistance give me a price of around $90. Right here, $90. Okay, so let's go back to our covered calls. Hopefully this is not too much information for you guys, and hopefully you guys are understanding exactly what I'm saying. So we're going to go back to the trade NU options, and we're going to go back to selling our cash secured put, and then we're going to choose our strike date back to December 6th. Now, as you can see, I will show you exactly why I chose the chance of profitability of 80%. Now, as you saw, the support and resistance for MU is around $90. So my perfect strike price that works for me is $94. Worst case scenario, I get assigned, which means I'm forced to buy 100 shares of MU at $94. Worst case scenario, I now own 100 shares. If the share price were to drop even further, there's a high likelihood it does not go past the $90 strike. Now, I can go ahead and be a bit more conservative and go with the $91 call, which increases my chance of winning this trade, but with only $30 as premium. Now, if you were to take $30 and divide it by $9,100, you're gonna have to determine for yourself if receiving only $30 premium is enough for you to be having $91 just sitting there as your capital. Again, that's gonna depend on you. Now, for those of us that like to take a bit more risk, what you can do is that you can increase your strike price. By increasing your strike price, what it does is going to reduce your chance of profitability. As you can see here, it's now gone down to 69%. However, look at your premium. The premium is now 1.69 or $169, which is going to be double of what my perfect strike price is. So once again, your perfect strike price is going to depend on your time to expiration. It's going to depend on the strike price you choose. And it's also going to depend on your investment goals. Remember those three things. Okay, so hopefully by now you guys have a little bit more information on how you could go ahead and choose that perfect strike price that works with your portfolio and also your investment goals. Now, the strike price selection must always be dependent on the balance of risk, reward, also your strategy. Keep in mind, there is no one size fits all, so please adapt your goals to whatever the market conditions are and also your personal goals and preferences. Now, I'd really like to know, what is your biggest challenge when picking your strike prices? Drop your questions in the comments below. And lastly, if you guys want to become better at choosing the right or that perfect strike price, it's highly advisable that you go ahead and learn the Greeks and also familiarize yourself with the option chain. That's going to help out a great deal. Now, the fact that you guys have made it to part 2 of this video, it means that you guys are really interested in options trading. So my ask is going to be that you guys like the video, subscribe to the channel, and if there's anyone out there you think that can benefit from this video, feel free to go ahead and share this with them. And hit the notification bell to always get an alert when I post a video. And until the next video, keep pushing your investments.